Hello everyone, and welcome back to the channel. The calendar shows May 23rd, 2026, and we are navigating through a brand new era in the markets where all the old rules are being rewritten. We have some incredibly hot topics on our desk today. The resurgence of inflation in the US, China's quiet shift in its economic playbook, the absolute madness in the gold to silver ratio, and most importantly, what exactly is the smart money trying to do? If your coffee is ready, let's take an X-ray of the global markets. As we move deeper into May, it's clear that the classic sell in May and go away motto isn't working this year. The geopolitical crises surrounding Iran and the Strait of Hormuz have shown a slight tendency to cool down. The potential for a deal emerging from the US-Iran talks has relieved some of the risk premiums in the markets, particularly easing the upward pressure on oil. The VIX, the fear gauge, which retreated in April, continues to stay low. Why? Because of the massively strong AI-driven earnings reports from mega-cap tech giants. The markets are currently walking a tightrope. On one side, we have supply chain and war risks. On the other, the massive productivity boom brought on by the artificial intelligence revolution. Over in the US, things are a bit complicated. The US economy kept rolling with a 2.0% growth rate in the first quarter of 2026. But the real issue has erupted on the inflation front. As of April, headline CPI has jumped back up to 3.8%. Why is this happening? Two main reasons. Energy and gasoline prices spiking due to war risks. The skyrocketing costs of computer and chip components driven by the insatiable demand of the AI revolution. Core PCE inflation has accelerated to a highly uncomfortable 4.3%. As a result, the Federal Reserve's entire game plan has changed. What is the Fed trying to do? The Fed has shifted to a strict wait-and-see strategy, keeping the policy rate locked in the 3.50% to 3.75% range. The markets were dreaming of rate cuts this year, but due to the pass-through effect of rising energy prices into core inflation, any rate cut before the end of 2026 is officially off the table. The Fed's sole objective right now is to choke out this second wave of inflation without sending the economy into a recession, aiming for that elusive soft landing. Looking at China, the reported Q1 growth of 5.0% might look good in the headlines, but behind the curtain, it tells a different story. In March, retail sales growth plummeted to just 1.7%, meaning the Chinese public is still not spending. Domestic consumption remains incredibly weak. So, is the Chinese government handing out the massive cash stimulus the markets have been begging for? No. What are they trying to do? Beijing has set its 2026 growth target to the 4.5% to 5.0% range, the lowest target in 30 years. Their focus is no longer growth at all costs. It is strategic growth. Instead of pouring money into real estate or handing it directly to consumers, they are funneling massive subsidies into advanced manufacturing, artificial intelligence, electric vehicles, EVs, green energy, and the low-altitude economy, drone tech. Additionally, a 90-day tariff ceasefire with the US has given a temporary breathing room to China's exports, which grew by 14% in Q1. Now let's talk about the precious metals we all follow so closely. Back in January 2026, gold tested the $4,690 level, and silver hit a mind-blowing $121 level. As of today, May 23rd, the waters have calmed down a bit. Spot gold, trading around $4,540 an ounce. Spot silver, sitting at $76.65. But the real metric we need to pay attention to isn't the price, it's the gold to silver ratio. Right after the news of the US-China tariff ceasefire hit in early May, this ratio plummeted from the 62 level down to 55 to 1 in just a week. What does this mean? Silver is currently being priced not just as a safe haven, but purely as an industrial metal. The immense demand for solar panel production and the boom in the tech sector are acting as a massive tailwind for silver. On the flip side, the geopolitical risk premium on gold has deflated slightly with the easing tensions in the Middle East. It looks like the smart money is starting to prefer the industrial upside of silver over the traditional safety of gold. To sum it all up, The giants of the global markets are currently planning for a transition period. The Fed wants to fend off the oil-driven inflation shock by cooling the economy with high rates. China is trying to stay afloat through high-tech exports rather than its old-school consumption and real estate economy. Investors are buying into the productivity boost that AI will bring to corporate balance sheets rather than trading on war headlines. In the coming months, diversifying your portfolios and keeping a very close eye on U.S. interest rate decisions will be absolutely vital. Thank you so much for taking the time to watch today. Don't forget to hit that like button, subscribe to the channel, and share your thoughts in the comments down below. What's your take on the gold to silver ratio? Let me know. I'll see you in the next market update. Take care and trade safe.